Hello and welcome to BYJU'S Exam Prep IAS. Welcome to the session on the big news, and in today's session, let's have a look at one of the very important articles that has appeared in multiple newspapers today. That is MSCI review. Is it going to cause more trouble for Adani Enterprises or Adani Group of companies? Now this is the snapshot of the article which appeared in Hindu newspaper. You take any edition on the 10th, that is today itself. Now in this article, multiple points are given. All the points are not relevant for UPSC, but what is relevant for UPSC? Let's try and understand those concepts now. First and foremost, in the last couple of weeks, I should say, the Adani Group of companies has been there in the news almost every day for one or the other reason. Now we are not going to delve into that discussion, but let's focus on the yesterday's news, wherein Morgan Stanley Capital International, MSCI stands for Morgan Stanley Capital International. There is a discussion that in the latest MSCI review, from the indices, the Adani stocks will be removed, or the weightage that is given to Adani stocks would be reduced. Now, what is the idea here? What you should understand from the context of UPSC. But before that, the moment this particular news was made public, that is in the latest review of MSCI, there would be a review, or let's say the reduction in the weightage or removal of Adani stocks in the MSCI index. The market prices of majority of the listed companies of Adani Group Enterprises, the market prices actually went down or again crashed. This went against the gains that these shares made in the last 2 days on the back of positive news saying that Adani Group of companies is starting to prepay, not even repay, prepay the loans that they have taken from different organizations or different institutions. Now, let's try and understand what is the news all about, what is the importance, why you should read this article. First and foremost, MSCI, as already mentioned, stands for Morgan Stanley Capital International. It compiles and provides multiple indices which involves, let's say, equities, different types of stocks, different types of bonds, etc., etc. Now, many of you ask me, sir, what do you mean by index here? Index is just a measurement. Simple. Do not complicate the topic here. Index is just a measurement. I'll give you certain examples. You must have heard of CPI, Consumer Price Index. Again, not related to Adani Group of companies. Don't add this particular concept there. Or you must have heard of WPI, Wholesale Price Index, or Index of Industrial Production. What are we trying to do in all of these? And by the way, all these are nothing but indices only. Under all of these, we are trying to measure something against certain set data. We are trying to measure what has been the movement of certain data, comparing that with other set of data. So index is nothing but a measurement. Point number one. Point number two. I said that MSCI publishes multiple indices. One of the index consists of multiple companies from India, and weightages are given for all these companies in the index. Now, what is the importance of this index? Simple. There are many investors across the globe. We'll simply call them as foreign institutional investors. There are multiple financial institutional investors across the globe who will basically follow the index and specifically the weightage that is given under this index for multiple companies. Now, it's little bit difficult. Let me give you a very simple example. Imagine you are a foreign investor. You want to invest in the Indian market, but you want to follow a particular index. In that index, let's say hypothetically, there are only 3 companies which are considered. Only 3 companies. And the index weightage that is given for company A is 40%, for company B is let's say 50%, and third company is being given the weightage obviously of remaining 10%. So totally how much? 100% weightage has been provided for these 3 companies. Now let's say you want to invest in India 200 crore rupees. How do you divide this 200 crore rupees if you're following this index? And this is called as passive investing. Simple. This is referred to as passive investing. In simple terms, the 200 crore you will divide into three parts: 40%, 50% and 10%. That would basically turn out to be 80 crore rupees in the company A's stock, 100 crore rupees in company's B stock or B's stock, and the remaining 20 crore rupees you're going to invest in company's C stock. Now 2 points here. What if this index which publishes, right, this particular numbers or gives a weightage and gives you this data? What this institution does is they will remove a company and give the weightage to company B. That could be one possibility, which means B's weightage will increase to 60%, one possibility. And second possibility is they will reduce the weightage of C from 10% to 5% and increase the weightage of B to 55%. So in the case 1 or scenario 1, where weightage for C has been completely removed, transferred to B, the A's weightage will remain 40% and B's weightage will increase to 60%. And in the scenario 2, I'll write it as case 2, the weightage for A will remain same, 40%, B's weight will increase to 55% and C's weight will be reduced to 5%. Now this 200 crore will be changed as per the weightage, or the investment from the 200 crore will be changed as per the weightage that has been provided both under case 1 and case 2. This is very, very important. Remember this. Why should you understand this? Simple. If MSCI goes ahead and under the review will change, reduce the weightage or remove the group of companies, or let's say some of the stocks within the index, don't you think either the investment in some of these stocks will come down because now new weightage will be used by the passive investors, or second, the investment in these stocks might simply fall to zero by these foreign institutional investors. And that is the precise reason I'm pretty sure you must have read in certain articles saying or raising a concern that it might lead, again, when the weightage will change, I'm talking about that. It might lead to outflow of investment from the stocks of Adani Group of companies. That is point 1, important. Please make a note of this. Second, there is a term called as a free float status. What is this concept of a free float? Let me explain here. Free float very often is cited in the newspaper whenever you are talking about a listed company. Now, what is the idea? Imagine here is a promoter of the company or the owner of the company. And this owner of the company will list the shares of the company. Henceforth, the company is called as a listed company. Take for example, Adani itself, or Adani Group of companies, or Infosys, or for that matter, right, many other companies such as TCS, etc. Generally, whenever a company is listed, as per SEBI guidelines, at least 25% of the total number of shares in a company should be sold to public. Public in the sense, non-promoters. Non-promoter means what? The owners of the company. Now, these non-promoters could be foreign institutional investors, could be individuals such as you and me, could be any other domestic investors as well. That is the guideline under SEBI. Now, this is point number 1. Second point, out of, let's say, I'll take a simple number here. Out of, let's say, 10,000 shares of a company, if only 25% of the shares are issued by this company to the public, that would turn out to be how much? 2,500 shares. And which means remaining 7,500 shares will remain with the promoter of the company itself. Now, it could be promoter, it could be even government also. Why that is important, you'll understand now. This number is important for a simple reason. Promoters generally don't sell the shares in the market. I hope you understand. Promoters don't trade the shares of their own company in the market. What will happen to remaining 2,500 shares? You can purchase, you can sell in the market, I can purchase, I can sell in the market. So out of the total shares issued for a company, if you deduct the shares which are held by the promoters or the owners or even the government, if these are deducted, whatever is left out, this is called as free float. I hope you understand. If you basically deduct the number of shares held by the promoters, owners or even the government, because government doesn't trade the shares in the market. If you deduct all of this, because these are not available in the market for trading purposes, whatever is left out, this is called as a free float. And is it okay if I say that if relatives of, again, owner of the company, let me not take the names here, let's assume A has certain relatives or certain shell companies. If the relatives or the shell companies which are related to A itself start purchasing even the shares which are there in the market, is it okay if I say the free float in the market will come down? I hope you understand. The free float in the market automatically will start coming down. It will raise concerns over how many shares which are truly available for you or me or for that matter various other investors to purchase or trade in the market are available. That data will be, or that number will be lower here. Now raising a concerns, MSCI stated that various investors in the market have raised the concern that the free float of these group of companies has actually come down, and that is the precise reason MSCI states I will make a review now, and based on that I might simply decide to reduce the weightage, or I might simply decide to remove the Adani Group of companies or certain stocks of these companies from the index. So these are the various important points. Now before I wind up the discussion here, one more very important point. Some of you, based on the discussion I've had so far, might simply come to a conclusion, sir, is MSCI targeting Adani Group of companies then? Is it that only because Adani's group of companies are there in the newspaper, hence they are going for a review? The answer is absolutely no. Generally, MSCI, I hope you understand this, generally MSCI, Morgan Stanley Capital International, goes for a review once every 3 months. And it so happens that in the month of February, their current review or the first review in the current calendar year is scheduled. And that is the gist of the article which has appeared in various newspapers on the 10th of February, that is today. If you like the initiative, hit the like button, provide your valuable comments in the section below, and if you are yet to subscribe to BYJU'S Exam Prep IAS, kindly do it right now. Thank you. Have a great day.